Hello, my name is Michael Scott Forehand. Today is the 4th of September, 2025. And today we're going to go do kind of a 30,000 foot view overview, really, of annuities, what they are, what they could be used for, should be used for. And we're going to take some Q&A at the end of this. As we move forward in time, we'll be doing these podcasts regularly. Our goal is at least once a month, maybe as much as twice a month. It just depends on how much time we end up having. So first things first. Let's see. If you're doing your plan for your future goals, your future income, your retirement plans, how many people want to know exactly how much money you're going to have every month in retirement, no matter how long you live? Pretty much everybody, right? And here's the thing. If you're doing traditional investment, traditional retirements, IRAs, 401, stuff like that, you have no idea how much money you're going to have or for how long. And that's when we talk to people that are close to retirement, that's their number one concern. It's not that they have enough money to retire. It's not that they're closer to death. Their number one concern is running out of money when they're in retirement. So this is an annuity is nothing more than a tool. That's it. It's a retirement planning tool. Okay. It is a protective measure because if you're using the right kinds of annuities, you can't have any losses, which is when we talk about getting close to retirement, what we say is the most important thing about retirement and investments is a return of your investment, not necessarily a return on your investment. All right. So I have a client of mine who lives up in Yorktown, Virginia. And that client had in 2021 $1 million of liquid capital sitting in a 401k. And that client decided at that time it was a great idea to retire. No more funding their 401k, just starting to take distributions from their 401k. And what ended up happening, if anybody remembers what happened in 2022, this is timing, folks. This is why this is important. If anybody remembers what happened in 2022, the market lost 36%, and then it bounced back up so that it finished the year only 19% down, 19.6% down. So for that particular client, what ended up happening was they lost 20% of their nest egg over a year. And the problem that they have is timing, because during that year, not only did they lose, but they also started taking and deriving income from it. So that has significantly impacted that individual's long-term retirement plan. The presentation that I made to them in early 2020 was focused on giving them an opportunity to sequester some, not all, but some of their money in an annuity. And if you think about, and we shouldn't, this isn't gambling, but if you think about it as in a gambling analogy, this is about taking some money off the table. Okay. One of those strategies for blackjack, for example, is you start with X number of dollars, and then as you start making gains, the X number of dollars that you started with go back into your pocket, and eventually you're playing with house money. This is kind of the same thing. If I can take my, in her case, $500,000, if I could have taken that $500,000 off the table, yes, she would have lost 20% of her 500,000 that she still had in the market. So she would have been down to $400,000 in the market and 500 plus the bonus that we would have gotten, which was 20%. So that 500 would have turned into $600,000 overnight and she would have been whole. But instead, she decided or opted not to pull the trigger at that time because she wanted to wait and see. And she ended up having only, at the end of taking her first distributions for the year, she ended up only having about $710,000. So she lost 200 in the market. She took 90 as income, and now she's down to 710. Her retirement income level for the rest of her life was significantly impacted because of timing, because she decided to retire at the wrong time. She decided to start taking money from that asset too early, which it made sense to take it because that's when she wanted to retire, but she had no idea that it was too early, but that's the impact. And so when we look at for her, what would have been a $100,000 a year income for the rest of her life if she'd done it the way that we have recommended, she is now stuck not knowing how much she's going to be making or how long she's going to be making it. She has no idea. And that's the danger of not, quote unquote, taking some money off the table. That's the danger of not keeping some of it safe, putting some of it in your pocket. And that's what an annuity does for you. It allows you to sequester some money. And usually there's going to be some kind of bonus or guarantee or something along those lines. Sometimes the guarantee that you won't lose any money is the best guarantee you can hear. Okay. Sometimes putting money into a fixed position in an annuity where you're earning 3, 4, or 5%, that's still pretty good. All right. So today let's break down annuities into plain English. What are they? And by definition, an annuity is a contract between an individual that owns the money and an insurance company that agrees to provide income, in some cases, income for life, which is income for life, or sometimes it's called income for what we call period certain, which means I'm going to pay you X number of dollars every year for the next 15 years, or I'm going to pay you income for 20 years starting in 10. Okay, so these are all variables that we can play with an annuity when we talk about the distribution model of the annuity. So if you think about what annuities are, and this is something we use this phrase all the time. What is an annuity? It's private pension. What is Social Security? It's public pension. What is an IRA? It's pension. What's a 401k? It's pension. It's a 457. It's a pension. Even though sometimes we're talking about deferred compensation plans and programs and 403s and stuff like that, they're still filling the role of a pension. But if you're in one of those pensions that doesn't have a guarantee of no loss and a guarantee of permanent income, then you're rolling the dice and you're hoping that your plan works out. And folks, I'm here to tell you, hope is a really, really bad financial plan. Don't hope. Know you're going to have the right amount of money that you need for the right length of time. Okay. So what kind of annuities are there? So you've got immediate annuities. What is that? That's an annuity that if I give you $100,000, you agree to give me $10,000 a year for 10, 11, 12 years. That's an immediate annuity. I'm giving you the money now. You're going to make a little bit of money on the back end. I'm going to turn that $100,000 into something a little bit more than $100,000 so I can drive income for a longer period than if I just stuck that $100,000 into my bank and took a $10,000 deduction every year, or reduction or disbursement every year. That's an immediate annuity. What is a deferred annuity? That's the other primary kind. A deferred annuity is an annuity that when I put the money into the program, whatever contract we do, you're agreeing that you're going to take it, you're going to invest it, you're going to give me access to some gains. Sometimes it's market gains, sometimes it's not. And you're going to make sure that when I'm ready, deferred, I'm going to defer the income stream to a specific point in the future. And then my income stream at the time of the contract, I'll know a floor. It's going to be at least X per year. And then depending on how well the market does or however my investment strategy has gone, whatever indexes I've chosen, whatever strategy I'm using within the annuity itself, however that's done, however that's performed, that's going to determine ultimately what the length of time that my money is going to last, maybe, or the amount. Yes. So I can do a deferred annuity for a period certain. We heard that word before. I'm going to do a deferred annuity that's going to start paying me a specific amount of money for 15 years, starting in 5. Deferred annuity. I'm going to do a deferred annuity that's going to pay me a specific amount of money for the rest of my life, starting in 5 years. Also, the deferred annuity. So those are the two primary kinds that we talk about, deferred and immediate. Of those types of annuities, there's subtypes. So what's a subtype? Fixed. I'm going to earn 5% interest per year in a fixed annuity, or 4%, or 3%, or whatever the fixed rate is for that particular contract. Fixed. Fixed indexed. I'm going to have an option to earn a fixed amount of money, whatever that is, 3, 4, 5%, or I can have some, most, or all of the money in that program indexed to an index. What do you mean by index? Everybody knows what the S&P 500 is. It's an index. It's a collection of the top 500 companies on the stock market. What's the Russell 2000? It's an index. It's a collection of the 2,000 best performing small cap stocks. What's the NASDAQ 100? It's an index of the top 100 programs, the top 100 stocks, equity stocks on the NASDAQ market. These are all indexes. And there's hundreds and hundreds of indexes that are out there. Now, those three indexes, let's go a little bit deeper into, actually, I'm going to talk about one more kind of annuity real quick. We have what's called a variable annuity. So variable annuities serve a purpose. In my practice, I don't like to use them because they can lose money. And if you read deeper between the lines, we'll talk about this in a little while about fees. Variable annuities can have a substantial fee associated with the use of those programs. And unfortunately, sometimes it's very difficult for the layperson to discern what the fees actually are. And even sometimes financial professionals will not be able to discern what the fees are because they're embedded. And it is what it is. So just know that variable annuities, the problem with them is that they can lose money. And if we're looking at using a variable annuity as part of a long-term financial plan, there's some holes in it because of the fact that it can lose money. It can also have that guaranteed income that we talked about with the fixed and the deferred. That can still be a component of it, but the problem is if I decide later on that I really don't like it and the annuity, that variable annuity in and of itself has been changed over time to the point where the actual cash value of the annuity is zero, which can happen, then I don't have a choice. I can't move it anywhere else because the minute I move it, if that's what I want the freedom to do, I'm stuck because there's no value to move. So just if you're thinking about doing a variable annuity, please, 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 please get more than one opinion. Okay, because they can be dangerous. Okay. So what does it mean? Here's a quick example. A fixed annuity, the contract can be something simple like, I'm going to give you $100,000 and you're going to agree next month to start paying me $500 a month income for the rest of my life. That is an example of a fixed immediate annuity. I'm going to give you $100,000. You're going to agree to pay me $500 a month for 25 years, starting in 10 years. That is a deferred annuity. That's the difference. All right. Let's see. How do annuities work? So annuities are financial instruments. So all financial instruments work in the same process. Accumulation, maximization, distribution. In this particular case, though, there is no maximization phase for an annuity. It is accumulation until you flip the switch and you start doing the distribution. So we don't have that middle part because once we start with an annuity, we're funding it. Most of the time, we're not doing continued funding. We're not adding in X number of dollars every month or quarter or year or whatever. Most of the time, it's just lump sum. We see a lot of that. There are some that are out there that are designed to be contributory where you can continue to add to them. There's a place for them. I just met with a client about an hour ago, and that was one of the questions that came up. Can I add to this annuity? And the annuity in that particular instance that we were doing was one that was going to give a very large bonus, immediate access to the funds that they needed them, but they couldn't contribute to it beyond year one. And that client, the concern that she had was that she had a property that she was going to be liquidating in the next couple of years. And she wanted to be able to move that money into the annuity. So the first annuity that we were looking at, and before we had that one piece of information, it wasn't appropriate because she didn't know when she was going to be selling that piece of property. So we didn't know when we wanted the money to come in. So we ended up going with another program, which allows us to have regular contributions as frequently as we want every year forever. And well, there's not forever. If you're 85 years old, they're going to stop taking money, usually. All right. So in her instance, that was the right one to go with. We sacrificed a program. We didn't go with the program that was going to give her a 20% bonus on day one. Instead, we went with a program that was going to give her a 12% bonus on day one, but she could continue to add contributions over time. So like I said, like I always say, there is no one size fits all for everybody. Every single one of these programs is customizable and should be customized based on the client. So if you're out there and you're listening to this and you're a potential client, you need to make sure you speak up. Okay, you need to make your agent, your broker, your underwriter needs to be asking the right questions, but don't hide things. There's no benefit for you to hide things and not tell the whole truth. Otherwise, you could end up getting put in the wrong program. Okay, and that happens unfortunately all the time. Okay, so you have accumulation. Generally, it's 1 year. It can be longer as long if that particular program is designed for that. You can have accumulation periods that are until you move into distribution. 1 year, maybe 10 years. Just depends on which program you're looking at and what your needs are. Payout. There's two ways that you can get money out of annuities. Actually, there's three ways. All right. How can you derive money from an annuity? Number one, this is a contract. The contract says I will pay you X for X number of years, or I will pay you X forever. That's what's called annuitization. It's not a bad thing, okay? But it can be bad. When you do that, when you start taking that distribution based on the contract, what's actually happening in most cases is you're actually decreasing the core value of the annuity. And if the program says I will pay you $500 a month or $5,000 a month every year for the rest of your life, and we're starting with 300,000, pretty much after the company has shelled out $300,000, there's no value left in the program. You can't roll it over. You can't move it. You can't do anything with it. I want to cash it out. Great. It's worth zero. Here you go. And they'll be happy to do it because they're no longer paying you $5,000 a month. So this is what I'm saying. It's possible to completely remove the value of an annuity, but the annuity still pays out because of the contract. Annuitization is when you do that. That's when you flip the switch and you say, I want a permanent payout, or I want a guaranteed payout for X number of years. One caveat to that. To my knowledge, there's only one company out there right now that will allow you to flip that switch and annuitize an annuity and then flip it off later so that it goes back into growth. Remember, accumulation, distribution. So when you move money into the distribution phase, you're usually flipping a switch to do annuitization. There's only, like I said, I only know of one company right now that actually allows you to flip the switch off and go back to accumulation. Okay. Period certain. We talked about that briefly. What are common lengths of time? You can have it for 10 years, 15, 20. Those are the standard lengths of time, period certain. I know exactly how much I'm going to receive for exactly how long. If I'm 70 years old and I do a 20-year period certain program, I'm going to receive money for 20 years. At the end of that, depending on how the program is structured, if I die before I've had all those payouts, that money might be sent to one of your beneficiaries, maybe. And it just depends on whether or not that's a rider that you've opted for. It could also be that, okay, well, you started this with 200, you grew it to 250, you're taking $12,000 a year, you die 6 years later, you've taken $90,000 or $80,000 out of the program, but you still started with 250. That means there's 170 left that can go to your beneficiary. Annuitizations is the primary method. These are called annuities. That's what they're designed to do, is create income streams, private pensions. Way number two, you can take a distribution. What does that mean? So if you want these programs to be permanent and have permanent growth, and the average return that you see in whatever program you're looking at is say 9%. If you take less than 9% per year, that program should be permanent. If I take out 9, if I take out 8, and it grew 9, that means it's technically having a net gain of 1% per year. That is if you take distributions. That is not annuitization. Third way, well, actually, there's more. Third way, required mandatory distributions. This number, even though we have a specific age in mind right now, which is 73, this number has changed 3 times in the last 6 years. Okay. So just because the RMD age is now 73 years old does not mean in 3 years it won't be 74 or it might be 72. What an RMD is this. Most of the time, when you have a retirement plan, you're putting money into a plan that is tax deferred. You don't pay tax on it up front. You're not paying income tax on it. So what is happening is you're growing the tax exposure on the back end when you start taking distributions. That whole thing that I just said, it follows when you move it to an annuity. The annuity has to follow the same rules regarding distributions. So when you're 73 years old, whether you need the money or not, you're going to have to take money on an annual basis out of your annuity. If that annuity is a tax qualified annuity, meaning you didn't pay tax on the money that started the annuity because you were putting money into your 401k and you took the money for the annuity from your 401k. All right. RMDs are the third primary way that you can take money out of these programs. Finally, number 4, and this is pretty common, you pass. So when you die, the money that's left in that program is going to go to your beneficiary, whoever you've designated, or if you haven't designated a beneficiary, or if your beneficiary passed, it's going to follow the rules that you set up with that distribution upon passing, whether it was per capita or per stirpes, which are the 2 primary ways that we use to determine whether it's going to follow the primary person, and go down their lineage, or whether it's going to be distributed amongst all the people that you list as beneficiaries. Okay. If that happens and one or all of your beneficiaries happens to be your a trust, then the money will be distributed based on the rules of the trust. There are some other restrictions, and this rule just changed last year. If you are the recipient of a beneficiary annuity, you have 10 years. That all the money that's in there has to be taken for you in 10 years. It doesn't mean you have to wait 10 years to take it. It just means that all the money has to be drained from that account in 10 years. So you could do it based on taking money based on what your income level, if your income level is not level, if it goes up and down. So on a year that you make a lot of money, you take less, which is going to be you're reducing your tax exposure, making sure you're not going above that next tax bracket. If you have a really bad year, you don't make any money, you can take more. Okay. So the idea is you want to take the money in a beneficiary annuity in an intelligent way to help reduce your tax costs. So four ways: annuitize it, take distributions, take required mandatory distributions, pass. Those are the four ways to get money out of an annuity. All right. So, what are some of the primary benefits? We talked about a couple of them already. First off, it's guaranteed income. You can engineer a guaranteed income stream. So, if you're doing financial planning and you're getting to the point where you do an income gap where the client says, yeah, I've got this much coming from Social Security, I've got a pension with my employer of XYZ, they're going to pay me $160 a month. I've got an old IRA that's going to pay me $300 a month, and I've got this money that we're moving into this annuity. I need it to pay me $1,000 a month for at least this 10-year period. Okay, easy. You do a period certain for 10 years. So that's part of this process. That's the guaranteed income. Another one of the reasons why we do these programs is tax deferment. If you are using qualified funds to start this program, like I have a money in a 401k, when you move the money, you do not, if you do it correctly, you do not create a taxable event. I still owe the tax. I'm just not going to pay it this year. I'm going to pay it when I start deriving income from the system. So the tax deferral component is important. If you're using an annuity and it's not a Roth annuity, the gains within the annuity are taxable. And these programs use what's called a last in, first out method. So if I start with $50,000 and that program makes $1,000 in the first year, and then in the beginning of the second year, I decide to take a $5,000 distribution from it, I owe income tax on $1,000 because that last in, first out, that was the gain. The $4,000 the other 4,000 I'm taking, remember, I said this was a non-qual, I didn't, maybe I did. This is a non-qualified annuity, so I've already paid tax on that money, so I don't owe tax on that. Even though I'm taking some of the principal that I started with, I only owe income tax on the $1,000. If the annuity is a Roth annuity, it follows almost all the same rules that a Roth has. I can take money out of the annuity. Both the principal and the gain are not taxable. If it is what else? What other ones would there be? That's the two primary things. You got either taxable or not taxable. Um, there are some additional benefits that you can get with an annuity. So, for example, if you're married, annuities can be structured to the benefit of both you and your spouse, which is kind of interesting. There are long-term care. Some annuities offer a long-term care rider, and you've got two different versions of this, folks. You have true long-term care, where that's recognized by the state that you live in. The money that you spent to have that rider is considered protected money. So when the state is going to step in and help you with your long-term care medical expenses, they're going to count that off and protect those assets. That's traditional, real long-term care. The other style is we can't call it long-term care because it's not. It's what's called an enhanced benefit. And all that does is there's a factor, it's usually some kind of doubling factor where it says, okay, you just qualified for long-term care. You just had a loss of two activities of daily living. Can't feed yourself, can't bathe yourself, can't dress yourself, can't drive yourself, can't take your medication, can't get in and out of a chair without help. Activities of daily living. And you lose two of those. That means that you would normally qualify for a long-term care support if you had a long-term care policy. And in this example, those enhanced benefit riders, the same qualifying event has to be present. So you've got that. Now you get to go ahead and say, okay, I'm going to use this money for long-term care purposes. Each company is going to have their different restrictions of how much you can touch. It's usually about 1/5 because they allow you to take that enhanced benefit over a period of 5 years. So while this is not traditional long-term care, it cannot be considered traditional long-term care, but it can act like traditional long-term care. All that's good. One more kicker with that program. The money that you're using, if you're using a traditional long-term care program, they're going to make you prove that you need to use it for XYZ and that XYZ was a covered event. I'm going to use it for in-home nursing care. I'm going to use it for skilled nursing care. I'm going to use it for a rehab facility. All those things, different places, because most long-term care programs won't pay for all of it. Traditional long-term care has that requirement. These enhanced benefit riders that you can get with an annuity do not. All they say is, did you qualify for long-term care? Check the box. Yes. Okay, you have X amount of dollars. We'll give you up to 1/5 of it. You've got 200,000, we'll give you 40,000. How much do you want? 40,000. You don't have to show them receipts. You don't have to say, can I use it for X? They don't care. It's your money. And as long as you're using it for medical stuff and you have a good CPA, then you're not going to pay tax on it because it's for medical purposes. All right. Uh, let's see. There's also, we're getting close to being done. We're almost there, folks. Drawbacks. What are some of the problems with annuities? So some annuities have really horrendous fees. And some of those things that I mentioned earlier, like variable annuities, those things are loaded with fees I've seen as much as 5.6%. So you put $100,000, it grows 7%, 5.6 comes off the top, you only got 1.4% growth, which means if you take into consideration the cost of money and inflation, you actually went backwards. Okay. So there's fees. Some fees are embedded and you can't see them, and some fees are right in front of your face. We will give you, like, a very common fee is a increased performance of an index fee. So for example, if I want the S&P 500 and I'm going to use a program that's going to give me a 100% participation rate, but it's going to cap me at 7.5% growth, I could pay a 1% fee and have the cap raised to 12%. So in that case, if you called it right, if the market made more than 7.5 points, actually in this case 8.5 points, if they're charging you 1 point, then you called it right. Most of the time, um, it's questionable to do that. What we know over a 10-year run, typically if you're using the buy-up feature, you're going to have about an 8% higher performance over that 10-year run. Doesn't mean you're going to get it every year. And it means that some years you'll actually have a negative number because you're paying a fee. I paid a fee to have a higher growth rate based on the S&P. The S&P lost money. I don't lose money, but I still have to pay that fee. So it appears that I lost money. I didn't, because I have a guarantee of no loss, but I didn't make any money. The index didn't make any money. I paid a fee to have an elevated growth. That's how you can lose, one of the ways you can lose money in an annuity. All right, next issue, lack of liquidity. So when you're putting your money into an annuity, it's a contract. And you're going to say, I agree to give you my money for X number of years. And with that contract is going to come what's called a surrender schedule. Sometimes they can be onerous. I'm not going to mention the company, but I've seen surrender schedule fees as high as 22%. Sometimes they're not bad. I've seen surrender schedules as low as 5% to start. It just depends on what we're trying to do with it. But there is a surrender fee. If I'm allowed to take 10% of my program starting in year 2, and I, for whatever reason, need to take 5% of my program in year 1, I'm going to pay a surrender penalty on that 5%. If I decide to take 12% and I'm allowed to take 10, I'm going to pay a surrender penalty on the 2%. The surrender penalty will change every year. As you go through time, the surrender penalty starts out here and it slowly goes down. One of the programs I was looking at today, the surrender penalty is at 12% year one, 11% year two, 10% year three, all the way down so that in year 10, the surrender penalty is 3%. And then in year 11, zero surrender penalty because I've completed the contract. Okay. So surrender fees are real. And that's another way that you can actually receive less money than what you put in if you don't do it the right way. So you do have a restriction of access to the funds, lack of liquidity, inflation. If you put the money in the program, there's different indexes that are out there. We already talked about the S&P and the Russell and all that stuff. Well, what about those other more esoteric indexes that we call volatility controlled indexes? So volatility controlled indexes are hedges against, usually hedges against down markets. So what they do is they reposition the funds in the index instead of being focused on equities, which we anticipate are going to lose because we're in a volatility controlled index, and volatility means a lot of people are trading. Instead of that, it moves it and transitions it over into real estate or transitions it over into bonds, a more safe investment. So where everybody else in the S&P index is flat because you never lose money, because we moved into a volatility controlled index, we actually made money. The opposite will happen. If you put money into the volatility controlled index and the S&P goes nuts, you're not going to see any gain in the VCI. And if you paid a fee to have elevated growth in that volatility controlled index, you're going to see a reduction in the value of your annuity. That piece feeds into inflation. Average inflation is 3%. That's the goal of the Fed. That's where we've been historically for a long time. If your program is making less than 3%, you're actually losing money because the cost of bread next year is going to be more than the cost of bread this year. The same dollars, if the dollar is worth 3% less next year due to inflation, then that cost of bread costs a lot more. That's what I'm talking about. So that's another danger, which kind of goes in line with having your money in an annuity to begin with. Okay. So we're trading off. We're trading off risk for guarantees. We're trading off some high-end gain for some guarantee of no loss. That's what this is all about. Complexity. If you've ever read an annuity contract, you've probably been confused. I have been confused. They are confusing as hell. There's things like an MVA. I haven't had anybody yet be able to give me a definition of an MVA without reading the stock definition of an MVA. There's other widgets that are in there, like if the program is not performing at X, then we're going to take 1%. Or we've got a guaranteed amount of growth, but it only triggers if you do this. Or we've got the guaranteed growth rate, but the guaranteed growth rate only happens if we have 4 years in a row of downturn market. It gets really confusing. That's another one of the detractors of an annuity contract because they are so confusing and can be. So all I can recommend there is get with a CPA, get with a financial professional, have them go through it with you and explain it to you. All right. So who should consider using an annuity? People who are worried about running out of money before they retire. People are worried that the market is going to have a downturn to the point where it's going to, like the woman that we talked about, the 2022 person, where her current nest egg was significantly impacted and will be for the rest of her life, and she can't get it back. Those people should definitely be looking at annuities. People that are really conservative with their investment strategy. An annuity is an investment. It is a very conservative investment. If the goal is not to lose money, an annuity is your friend. If the goal is to get super high market gains, the annuity is not the answer. Okay? This is if you're 20 years old, should you put money in an annuity? Maybe. If you're 50 years old, should you put money in an annuity? Probably. If you're 65 years old, should you put money in an annuity? Definitely. Okay? So these things all come into play with risk and timing. All right. So, what are annuities? It's a contract between you and an insurance company. Why would you use them? Because you want to guarantee the value of your asset. You want access to some growth, but you want a guarantee of no loss. Why else should you use it? Because I want to know exactly how much money I'm making in the future. I want something I can count on contractually. And that's it. Now, whoever's got any questions, feel free to ask.
I got a question for you, Scott.
Market volatility adjustment, MVA.
You said that in Denver when I asked you a question there.
Okay. What do you got?
What if you had a pension
Uh-huh.
that started when you're 65
Okay.
and pays out on a monthly basis? Is there a way that you can take that and keep from having to pay taxes on those dollars once they're distributed each month? Can you have them go into an IUL,
Is your pension a
annuity, or
tax
something like that?
qualified pension?
I don't know.
I don't know any that aren't, but you never know. All I can say is this: there is no way around paying taxes on money that you haven't paid tax on. If I put money into a pension, or the company that I work for put money into a pension for me on my behalf, that's income. And if I didn't pay income tax on it at the time that it was put in there, I owe income tax on it when I receive it.
So
Now,
you can't defer it then?
so we work with a group of really, really bright tax professionals, and there are things that can be done. Okay. But for the general public, it's usually not something that's available. There has to be a fairly large investment that's going to be made. And then you can do these tax defer strategies where you can actually defer. There's one that I know. You can actually defer the taxes out 30 years. Okay. But it's not for somebody who's got $300,000 in a pension or even $1 million. Those are high net worth people because it costs money to do that stuff. So there's tools out there. And I did a show, I guess, about 2 months ago. We talked about different tax defer strategies like conservation easements. Like here you go. I'm gonna take $70,000 out of my pension. I'm gonna owe income tax on $70,000. Okay. And I take that $70,000 and I go buy a piece of vacant land. Okay. And then I do a conservation easement on that piece of land, which says I record on the deed as of this date, this land can never be developed. You can build no structure here. You can't do utilities on this. It has to maintain it be vacant, conserved land. It doesn't mean I can't sell that land or sell the rights to log that land or farm that land, but I can't build that land. So in that example, that $70,000 that I just spent on that piece of land, it just established the value of that piece of land. And then I do a conservation easement, which gives me a $70,000 write-off. So now I own this piece of land. I owe tax on $70,000 of income, but over here I get a write-off on $70,000 because of a conservation easement. It's a wash and I don't pay tax. And now I've created an asset that's earning income for me. I don't have the $70,000. That's that's the equity. But maybe I get a farmer to rent it for $3,000 or $4,000 a year. Or maybe I get there's timber on it. I hire a timber management company and they come out and they start chopping down the trees. So there's tools that are out there that most people don't know about. And these are wealth problems. Okay. These are solutions to wealth problems. Does that help you, Kevin? Okay.
Yeah, it does.
Anybody else got any other questions? All right. Well, thank you for being. We usually do one or two annuity shows a year. And like I said, this is the beginning of our podcast process. So we'll be doing a lot of these over the course of the next years or so. If you ever have any questions, if you're here, you probably know how to get a hold of me or somebody who invited you to this. So you can get them, you can give me a question and I'll cover it on any of these shows. And there you go. Thank you everybody for coming. Have a great Thursday. I believe there's football on tonight. Bye.